So right now you can see that on ERX we have a high here, we have a slightly higher high, we have a strong base around 27-ish, and it looks like this security is trending up nice. We have a positive DMI. And I would say that for the most part, everything looks relatively bullish. I mean, we have resistance around 35, which is our strike price, and on a day-to-day up about 3%, 2.5%. I think this can definitely continue trending higher. So I don't think closing this out is the right thing to do right now. The trade is definitely producing for us. I think we have net liquidation. So I'll talk through some of the market internals later. Right now, it's all about managing these positions for the next hour and a half going into the market close here. So this is a $4,400 trade. It's up $1,400 on a $3,000 investment. So it's up right around 45% in the last 6 weeks that we put this on. And the beautiful thing about this is now that we're in the green, there's a lot more flexibility about legging into a diagonal spread, which could make a lot of sense. So ERX, let's take a quick look at the option chain. So the volatility is very rich for these front weeks. So one thing that you have to weigh out when you're rolling or selling, because this position right now has 5 long and 5 sold. So I could go out and sell 5 right now if I wanted to and just let these expire worthless. So if you don't have the relationship set up with your brokerage company to have no commissions on buying back options under 10 cents or 5 cents sometimes, then a lot of times it might make sense because there's still about $30 a day in theta here. And you can see that the net liquidation, that negative 62.50, that means there's $62.50 in value left on these sold June 17, 35 calls. So first thing I would say is look at the option chain and just kind of glance through the volatility, see where you can get the most premium for your position. So right now you can see that the July one has the 79.04% IV, which is definitely the highest that we're seeing on any of the near-term months. So when you're long out to January, you got 219 days. You have all of this flexibility, and there's still going to be several more weeklies that aren't even out yet and other standard months. So this is a position that can really continue to produce well as long as we manage it the right way. And managing it the right way is selling premium when you can. So one of the drawbacks right now that I'm seeing is there's no bid on any of these 35 calls or higher for the July ones. So that's a drawback on trading stocks like ERX that aren't as heavily traded as others, because this is a leveraged ETF. Sometimes you don't have the open interest that you need to gauge the interest that you want for tight bid-ask spreads. That means you just got to keep looking. A lot of times the regular monthly option, which is what these were, the regular June monthly options that expire today. You can see they're in black. Weeklies are in purple, depending on your platform settings. But go out to July regular. It's still a 76%, so it's only a couple percent lower than what you could sell here. And you can see that the bid is definitely 50 cents, 60 cents. You can probably get about a 60-cent credit on these July 15, 35 calls, which to me makes a lot of sense because the probability of these expiring worthless is about 80%. So 83% is the current metric right now. I think that could definitely change on a move higher, but say 80%, 70 to 80% chance that these will expire worthless in the next 30 days. And furthermore, that 60 cents is well over 10% of the new cost basis or the new mark value. So this 445 is what the contracts are worth right now. They were purchased for 317. So if you look at the purchase price, getting 60 cents on a $3.20 purchase option that's up this amount of money means you're getting a 20% return, so to speak, on these individual July options, which is a great return. And if you can do that every month up until expiration, and if you see the stock slowly trending into the mid 35 range, that's the perfect situation. The only thing that I would say is when you sell these calls, don't get attached to having it expire worthless and keeping that premium, because a lot of times if things change on you, your delta is always going to override everything. So taking off a little profit is never a bad idea. Because this position's not up 100% yet, I don't think we have to do that. It's continuing a bullish trajectory. We can definitely move up to mid 30s. I think 35 is still a very realistic target in the next couple weeks and month ahead. But then again, if the stock moves up to say 32 by next week, it would be a lot more effective to wait and sell the calls when the stock price is higher. So one thing that you can do, which is a little advanced, is to take the delta of the actual, now that we're kind of midway through these classes now, it's going to kind of take it to the next level. But one of the tricks that I learned when I got started in this business a long time ago was using the individual delta on the actual contract. So this is a little more confusing, but all you have to know, it's everything still applies. So when you see a $1 change in the ERX, this means that these 15 July 35 calls are going to go up about 21 cents. So if the mid price right now is, say, 60 cents, right here we can go to the mark, 62.5 cents. So if we go up from, say, we're at $30 right now, if we go to 31, this could easily turn into 0.82. So this is something that when you wait, and sometimes when you put a sell order to sell these around 90 cents or $1, the stock can go up $2.30, which is not that significant in the next 30 days. And of course, as time passes, this number will diminish. But all I'm saying is don't always get complacent with the current market price. ERX, we're looking at the 35 calls. And selling at least 5 of them now is not a bad idea. And when these expire off the books, so what I'm saying first is really don't need to buy these back right now. I mean, they're going to expire worthless unless we see a crazy move higher today or tomorrow or Friday, which is heavily unlikely. You can see that the probability of these expiring in the money, we have a 6% chance or 7% chance that these front week or front month now, June 17 options will be above 35 for this underlying. So we have a 94% chance that these will expire worthless. So keeping these on and saving $10 or $8 in commissions and extracting this final $63 is something that I think is okay, especially when we have unbalanced relationship that does not factor in any gamma risk. So even if the stock went to 35 tomorrow, we would still be okay, and that would not intervene with our delta, which is really the most important and the most heavily gauged option Greek of any and all of your leaps positions. So what I'm going to do right now is I'm going to go out and sell the July 35 calls. The hardest thing to do is the timing. That's definitely the trickiest part of this business. So using multiple time frames, like if you're selling a 30-day option, look at the 30-day 1-hour chart. If you're selling a longer term option, then maybe you go out a little longer term, but a lot of times you can use even a 15-day 30-minute or 10-day 10-minute for some of the weeklies. So you can see on a weekly basis, we've been in a downtrend. We broke out with a nice volume surge here today, trading up from 28.5 to almost 30 now. So it looks definitely like we can trade back up to the lower 30s. So what could be a good move right now is not to be completely complacent with the current price and maybe try to sell 3 of these at 80 cents. And then just make sure that you change that from a day to a good till cancel, because most likely we're not going to be able to sell these for 80 cents today unless we saw a late hour-and-a-half surge going into the close. So this is a really good practice that we have not discussed that much in depth, but it's something that when you're in, and this is the other context of doing this, is when you are in a profitable position, you have the luxury and the ability to manage your trade a little differently. A little differently meaning not having to be so meticulous with keeping your Greeks in a positive theta metric all the time. I mean, sometimes it's going to be okay to have a slightly negative theta. If you're in a strong trending market that has positive delta and a positive gamma, you can definitely, those two quadrants far overshadow and are far more important than the theta quadrant. The only thing the theta quadrant is really valuable in is recurring revenue, recurring income. When the markets close, when things are going sideways, when you're in a choppy trend, just like right now from the Tuesday here on June 6th till this Tuesday, the stock's at the same price. So all of that 1 week of time is beautiful when you have a 30 or 40 positive theta every day, because you're going to make $300-400 through that sideways trend. The one thing I would say about that is when you have a higher open interest number, the market makers, which are pretty much owning this entire strike right here, they can take advantage of you a lot easier when there's lower open interest versus when they have 800 other traders like you and I out there, or institutions options or whoever owns these contracts, there's a market there. There's liquidity there. Although the spreads are still pretty wide, that's something that would definitely be more advantageous than something like these in here. So let's go ahead and get that in and then move on to the next one because we got a lot to discuss. So selling the July 15, 35 calls. A lot of open interest in here too. There's plenty of liquidity to do these types of orders. I want to look at one more thing real fast before I pull the trigger. The July 1, 16 days till expiration, 35 calls have no bid. So what I'm going to do is I'm just going to test this and see what happens. So when you learn the strategies and the mechanics, you can always practice things and mess around with people. So if I see a 125 ask on these, let me see if I can sell these at a 50-cent bid and watch what happens to the July 1 35 call. So we're going to go ahead and send this in. The mid price is actually 60 cents, but if I can sell the July 1 that expired in 16 days at a higher implied volatility and bring in pretty much the same credit as going out for an extra 15 days. The 35s here, that's a 60-cent mid price. It's a 10-cent offset with 2 extra rolls there between July and July 15. I think this makes a lot of sense. So what I want to do now is just show you what happens when you want to test the market makers and give them a run for their money. There's only 28 open interest contracts on these July 1 35 calls. I'm going to try to sell one at 50 cents. Most likely we're going to see everything change here. So that shows you the credit of $50 minus the $1.25 commission. Boom. So you see how the ask just came down to 50 cents? This is the risk of trading thin markets, is you become the market maker. So if for those of you that maybe you were in, this is what can be really frustrating too, is I've noticed this on these January 17 leaps out here, is for those of you that might have a position, which I'm sure no one does, but if you had a position on, say you bought a call option on these July 135 calls for the mid price of 60 cents, which technically was fake, and the stock really hasn't moved too much, your P&L on your trade profile is just gotten cut in half because I put out a sell order and the ask price has got basically cut in half, if not more, from $1.25 to 50 cents. So what this is telling me right now is there's no takers. There's no one willing to buy these 35 calls from me that I'm selling for July 1. That's the risk. That's the risk of A, becoming the market maker, is there's no one that you can sell your stuff to, and B, the spreads will eat you alive if you own anything there because you can see things widening up. And when you have a 50-cent bid, at least that will legitimize that contract to get an offer out there. Because if I sell one right now for 60 cents, I think this is really good to practice and see how this reacts. So the July 15 35 calls, bid is 50 cents, the ask is 75. I should get filled at mid price at 60. So let's go ahead and try that. So 35. So look how the market just tightened to 5 cents. So now, really important thing, the market makers that just had the offer at 75 cents, they now lowered it to my bid, which is the new ask at 60. So this little, I don't want to say manipulation, but it technically is. We are manipulating the market right now, and even on a contract that has 2,841 contracts open interest, you can move the markets with one contract, which is scary. That's why you have to be careful when you're doing this, and you have to understand how things will change and how you can adapt and really maneuver yourself with your positions throughout all the chaos out there. So what this is telling me now is that the market has changed for no reason. The stock price hasn't moved at all, maybe a couple pennies, but now they're making me sacrifice 5 cents. So basically, the way I read this is this 60-cent mid price, which was just the legitimate mid price, is now turned to 55 cents. So because the bid-ask spreads are now much tighter and the ask tank came down, I might have to wait here for an hour and a half to see if I get filled at 60 cents because that's the ask. So if I move it to 55 cents, this is how market makers get paid. They get that 5-cent differential to where they'll be able to make their little spread. It's called slippage. It's called unfair advantage. It's part of the business that as long as you know about it, you know how to navigate through it or avoid it, then that's all you can do. But that's there, and I'm going to keep on talking about some more ideas because we have a lot going on. So up here you can see the ERX position. These 35 calls, the stock only went up 50 cents today, and these are showing a pretty large profit today, which could be false. So one thing I want to show you now is what I was trying to explain earlier when you're in a thinly traded contract for a Leaps example, and right now my mark is 445. I should be able to sell one for 445. So let's see if that works. The mark is 440. I'm going to go ahead and sell one of these to explain how this works. And if we go down and look at my position flag right here, plenty of open interest. The bid is 380. I guarantee you when I come in at 440, this ask is going to change to 440, and the mid price is going to now be the difference between 380 and 440, which is going to be a new mid price of 410. So watch this. This position right now is up $900 today, and the P&L open for these 35 calls is showing 1280. This is about to get cut down by $300, I would bet. I could be wrong, and I have been wrong in the past, but I'm pretty sure by the way that this underlying is trading that this is most likely going to happen. So I'm selling one of these at $1.25 profit, so not a bad return for a month and a half, a little less right here. So I haven't gotten filled yet. See how the 440 just came down? 380, 440. I just moved the market on an 843 open interest contract. I mean, that doesn't seem right. Look what happened to my P&L. So there was some artificial pricing in there. So when you are doing this yourself, you're most likely going to experience this at some point in your trading leaps journey. And as long as you can navigate through that and you understand why that would happen, then again, that's all you can do. So basically now, because these spreads are getting changed, now I should be able to be able to sell this for 410 because 380 bid, 440 ask, which just got moved down. That the 440 used to be the mid price. Now that's the new offer price, which means that 30-cent differential, $30 a contract, that's going to get moved in the market maker's pocket. So I'll do this to sacrifice for the integrity of this teaching, but this 410 mid price, now when they keep changing it on you, that's when you know you're getting really taken advantage of. So let me highlight this right there so you can see what's about to happen. So this should get filled for 410, especially after a modification from the recent mid price of 440. Wow. So now we just brought down the bid and the ask to 30 cents. So what this is telling me right now is there's no one taking the other side of this trade. So look at that. Now the profit that was $900 today is now down to $400 because there was artificial pricing that was manipulated inside these January 17, 35 calls. That's the risk of trading options that are not tightly traded on the bid-ask spread and that have low liquidity. So what I'm going to do right now is I'm going to cancel this because now look, it's the market's come down to 395. So basically what the market makers want you to do is they want you to cave in like 90% of new traders and just sell your contract at the bid for 380 and you'll get filled at 380. But you should be able to get filled at theoretical mid price, which is the frustrating part. So I'm going to cancel this and the mark probably is going to go back to what it was. Might give it a few minutes, but right now my offers are off the table. I have no open sell orders on these 35 calls for January 17. And because of those, basically that fake pricing, now I've recalibrated the real P&L for the day and the real P&L for the open. So it's not so much a 45% return. It's more like $900 divided by 3,000, which is like a 35% return. So there was a 10% of return or gain that was fictitious. It wasn't real because you just saw how he modified the marks and how he adjusted on a very small example with one contract, not only on the July options up here that we're trying to sell, but on our Januaries that we own. So what do? You could either always sell for the bid or at least keep coming down and basically become prey and just do what the market makers are making us do, which is continue adjusting down until we get filled, which now the new mid price, if we go to the mark, is going to be $395. So it would be really bad if we did another order to sell for $395 and that becomes the ask. So a lot of times when you're in a thin day or there's not a lot of activity going on, looking at the volume helps. So the reason why this is definitely clear now because we're looking at the next element here is there's no volume today. So we're basically trading with the market makers. That's why they're modifying the bid asks, and that's why things are not working right now or not getting filled, is because there's no activity. That's the risk of trading stocks or options that have low open interest and low volume. Is you're going to have this discrepancy of price that can make for difficult decision making because you don't have the proper position statement details. It's hard to make a decision or make a trade update if you don't have the right information that's in your position statement. So that's something that you have to work through. The way that I always work through these problems is A, knowing that it exists, and B, selling premium that has a high chance of expiring worthless, kind of like what we've been doing. So when I see something like that happen, that makes me want to go out and sell as much of this as I can. So 50 cents to sell 4 of these, I mean, that's $200. It's nothing substantial, but again, it's at least there's some volume there today. I mean, we should definitely get filled around 50 cents. That's at least it's better than the bid. It's not the mid price of 52.5 because we can't get that 2.5 cent pricing, but 50 cents is something that will help offset some of what we experience with that mispricing. And when these expire off the books on Friday this week, these June 17 35s, we'll lose all that theta, and then this will be losing $14 a day over the weekend. So it doesn't make sense to have at least a couple of these sold. I think selling 4 for 50 cents is $200. The way that I would calculate this in my head is just, there's 30 days until expiration. $200 of credit divided by 30 days is about $12 a day. So if I analyze this trade and I uncheck this and select that, so $10 a day is the more accurate theta. So at least that covers, and that'll go up too as time gets closer to expiration, but at least that covers 90% of that, which is really the whole goal of doing this in the first place. That was definitely a pretty thorough explanation on pricing discrepancies on a leveraged ETF. Still making money in this, and you can always still sell at the bid, so you don't want to ever panic, and that's why we trade leaps, is we have all this time to navigate through that chaos. And a day when you have oil up big or energy sector up in a strong way, this ETF is probably going to see a lot more activity, and that's a good time to start taking off, scaling out, or selling calls, is when there's a lot of volume and a lot of activity on a busy day. So since it's not a busy day today, you're not going to get the best pricing. You're going to get taken advantage of.